Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's April 12th. Our note this week was titled Inflation, Margins, Earnings, and Business Cycles. As is frequently the case, this was a very dense note with a broad discussion about the longer-term inflation and growth outlook as well as the policy outlook. We began with a section titled The Fed's Admission. We've been arguing that the real driver of higher rates in the first quarter was not improving growth outlook, although that's been improving much faster than policymakers or market participants expected. It was not the rising inflation outlook, though that has continued to provide underlying pressure. We describe that as the second most important factor in driving rates higher. The rates rally began on January 5th when the Democrats took both of the Senate elections in Georgia and ushered in a blue wave. Now, we've written a couple times about how when Fed Chairman Powell testified, there was no admission that rates might be influenced by higher supply of treasuries, all of the deficit finance spending, 5.3 trillion and counting so far since the pandemic began. But in the FOMC minutes that came out Wednesday last week, there was a somewhat esoteric but important, we'll call it admission from the Fed staff that may indeed be a major factor in driving rates higher. We'll read it to you really quickly. Model and survey-based estimates suggest that a significant portion of the increase in yields was associated with an increase in term premiums. Higher term premiums could reflect the outlook for more expansive fiscal policy and an associated upward revision in the expected path for Treasury debt outstanding. We've been simplifying the argument and not really delving into this term premium concept and just separating rates into real interest rates, which is the non-inflationary component, or Treasury inflation protected securities yield, and the inflation component, market implied inflation or inflation break-even component. But this is a very similar argument to our real rate argument, and it's that this may indeed be the driver. Now, this was important because as the Biden jobs plan ran into resistance, the Treasury market has settled into a range that's allowed some of the so-called high duration equity sectors and industries to rally alongside the cyclical sectors. And it's just created a very positive environment where growth is improving, policy risks are pushed back, and the Fed and Treasury are pumping a massive amount of liquidity into the system, making the rally in the equity market fairly relentless at this stage. We're going to test that a little bit this week because Treasury supply is going to be at record levels, so we'll see how the market absorbs that. It should be interesting. And in the long run, while we think this is a factor and it's important in terms of thinking about just how much debt the U.S. really can float before the market pushes back on it, and the market, in our basic thesis here, is that the market needed to reprice all this deficit finance spending. Inflation expectations will be the real driver of significantly higher rates through this business cycle if we're indeed correct that the 39-year bond bear market is over. One other notable market event is that the VIX is finally below its long-term median level around 17. Yet the term structure, that is the difference between 1-month options and say 6-month options, is exceptionally steep. It's about twice what it would normally be. Additionally, skew, or the premium you pay for out of the money options, is still quite high and higher on the call side than it typically would be. So given our outlook that we're at this point where we're getting the maximum growth improvement as the reopening process occurs, but policy risks are building, that sets up pretty nicely to buy near-term calls and sell longer-term out-of-the-money calls, so-called ratio call spreads. And so for those that are inclined to trade options or position themselves around options, we think that's a pretty good, you get a fair bit of edge by buying that near-term say shorter term, shorter dated option and selling longer term out of the money calls. So moving on, the next section was about the tax plan and some of the pushback that the Biden administration received to the tax plan. Chair Yellen has been describing this in a speech she gave in an op-ed in the Wall Street Journal as a global race to the bottom. We think the causation here is all wrong. We were actually losing the race. We had not changed our corporate tax rate since the 1986 tax reform and had fallen to the bottom of the barrel in terms of corporate tax competitiveness in OECD or G20 in terms of statutory rates, average rates, effective rates. All TCJA did was put us in the middle of the pack. The Biden plan would put us back into a very uncompetitive position. And if you move on and think about this minimum global tax that Treasury Secretary Yellen has proposed at 21%, the probability of the rest of the world accepting this, we think, is quite low. When we heard it, all we could think about was when the Europeans went through their sovereign debt crisis, the Irish had a banking crisis associated with that. The main German requirement for getting EU support to Ireland was that the Irish raised their corporate tax rates. The Irish held out and never raised their corporate tax rate. Given that they didn't do it under the stress of a sovereign debt crisis and a banking system that was bankrupt, we doubt very much, pardon me, that they're going to agree to do it now. The Netherlands has a technology box where you can book IP in the Netherlands and get a preferred tax rate. And they have very prudent fiscal finance. They're not going to agree to this either. It's just a bit of a pipe dream to think that the world would agree to a global minimum 21% tax rate. And then finally, the minimum US tax rate that's been proposed in this plan would basically mitigate the effect of the R&D tax credit, something that the Biden administration has said is a goal. It would mitigate the effect of the Made in America tax credit, and it would reverse the progress that was made in the Tax Cuts and Jobs Act in reducing the effect or the effective tax rate on debt versus equity, right? Debt was very attractive relative to equity. Prior to the Tax Cuts and Jobs Act, there was a huge premium or incentive in the tax code to finance with debt. Tax Cuts and Jobs Act offset a lot of that, which is probably a pretty good long-term goal. You would not want people funding with debt incessantly because there's a tax incentive to do so, and just loading corporations up with excessive debt such that when we got to recessions, they'd be in a precarious position. So all those things were major issues for, we would describe across the economic spectrum of tax policy think tanks. So both the Wharton Tax and Tax Foundation, which we'd put on opposite ends of the spectrum, agreed, as did the Tax Policy Institute, that this would raise less revenue than the Biden administration thought and reduce growth because of crowding out of private sector investment. So we think they kind of have to go back to the drawing board on this. Finally, it's a misnomer to say that the Tax Cuts and Jobs Act did not work. There was a boom in R&D spending. There was a boom in software spending. There was initially a boom in structures or physical plant investment as well in early 2018 till the negative business confidence shock associated with the Trump trade war mitigated that effect. And finally, the labor share of income as measured by the non-financial corporate sector, which is probably the cleanest read of any of the various productivity labor share of income measures, that was moving up or has been moving up sharply. In 2014, it was 56.6% at an all-time low as labor share of total corporate income. Pre-pandemic, it was up to 60. It's now 63.7. And just for some perspective, in the 80s and 90s, this tended to be in the 62 to 66 area. So we're back into the longer term range, and that's likely a consequence of the Tax Cuts and Jobs Act as well. Now, final point on this, which is the timing of when the market would price higher taxes. And we do think higher taxes are coming, notwithstanding the flaws of the structure of their corporate tax hike. But by the end of the year, sometime late third quarter, early fourth quarter, to be implemented in 2022, we expect to have higher individual corporate tax rates and rates on capital. And if you think about the Trump administration's first year in 2017 and how that progressed, they started with repeal and replace of the Obamacare plan. That failed in late July when John McCain cast the deciding vote against it. At that point, the market's confidence in the Trump administration's agenda was at a sort of a very low point, as evidenced by sector action and based on who would be the beneficiaries of a corporate tax cut. By November, the market was starting to price the Tax Cuts and Jobs Act being passed, and it was finally signed in very early January. The final agreements went through the House and the Senate in December. Final agreements were made around Christmas time. So, if this is indeed going to be done in the late third quarter, early fourth quarter, we don't expect the market to start to discount it until after Labor Day at the earliest. That still gives us a decent window where that policy risk is pushed back in time. And as far as the Fed goes, there was quite a bit of Fed speak last week. Chairman Powell was on 60 Minutes last night. It's pretty clear that they've changed their modus operandi from being preemptive to outcome-based. And so they are likely to look through the strong inflation readings in the second quarter. They're likely to look through stronger employment readings in the second quarter. And so, as we've been saying, the June meeting could be tense, and that could cause some disruptions in the markets. But we don't think they'd be ready to even start talking about the tapering process till, again, September at the earliest, post-Labor Day. So that's where we're at with policy risks. Final section of the note was titled Inflation, Margins, Earnings, and Business Cycles. And again, we wanted to reiterate as we came into earnings season, there will be some evidence perhaps in the industrial sector of margin pressures. This is a function of the business cycle. Prices paid go up first. Those are related to commodity prices. Prices received as businesses pass those prices through. We're seeing this in the auto industry now, then start to rise. And finally, as revenues go up, that helps businesses clear their fixed cost, right? The prices paid versus received is a marginal cost argument. But as revenues start to really recover sharply, that covers your fixed costs and profit margins start to rise at the corporate level. So again, this is a business cycle phenomenon. And if there's any evidence of margin pressures in the numbers beginning this week, we think the market will look past that. It really is all about operating leverage and the go forward outlook. So final point here is we did a little bit of a recap in the note about our inflation outlook. We definitely think that inflation is not going to prove transitory. It is both cyclical and secular. Our cyclical arguments are all around sectors like housing and autos, where prices are likely to rise through the cycle. But really, the secular argument is all about global goods prices. That's the primary source of disinflation for 3 decades. And we think that those prices are not going to have the same, disinflationary effect that they did over the last 3 decades as businesses restructure supply chains from just in time to just in case. And so while the Fed will look through these strong readings in the next couple of months, including this week, what we'd be focused on, perhaps even less than Tuesday's CPI report, would be Wednesday's import price series. It's already started to rise on an ex-fuel basis. Prices from China are starting to go up. And we think that's going to be the primary source of moving those aggregates to higher levels. Remember, service sector prices have been above 3% through this entire 3-decade disinflationary trend. Those are endogenous or domestically determined. They've been above the Fed target. It's been those global good prices that have fallen, and they fell particularly sharply after China was admitted into WTO in the 2000s, but they still were a drag on the inflation aggregates in the 2010s. And that's going to be the main source of why we don't have disinflation in the 2020s, and the aggregates start to rise over time, like they did in the 1960s. One final point here. Again, we keep making this point. Reflation is not inflation, right? So in the early stages when prices are rising, this is a good thing for equity markets. This is what happened in the 60s. We had the PE had risen from 7 at the end of World War II to 20 by the time JFK was elected. But in the 60s, we had stronger capital investment, much stronger capital investment. We had much stronger earnings growth. We went from roughly 8% to 15%, and that helped equities maintain those high multiples until later in the decade when inflation started to get out of control. And then as reflation turned into inflation, that pressured equity market valuations and pushed multiples down to eventually to single digits. But for most of the 60s, they held at those very high levels. The earnings yield was below 5 as a way of saying the PE was 20, just like is the case today. And it was a good period for equity investors. So don't panic about inflation yet, but it's coming for sure. That is a problem, though, for bond investors to make that final exclamation point. So that's it for me this week. Please, if you're not already a subscriber to our YouTube channel, our podcast, and hopefully to our becoming a paid subscriber to our written research where all the details, charts, graphs, tables, specific recommendations are, we'd love you to consider becoming one. We do offer 30-day trials. If you'd like one, please let us know. Barry Knapp, Ironsides Macro. Have a good week.